Whenever we sit down to look at corporate earnings, I always think of it like reading a student's report card. Like most companies have that one subject they really struggle with, or, they're just aiming for solid Bs across the board just to keep their investors happy.
Right, just doing enough to get by.
Exactly.
Yeah.
But today, we are looking at the kid in the class who only wears designer clothes, orders sparkling water at the cafeteria, and somehow always gets straight A's in luxury hospitality.
That is a very highly specific, but honestly an incredibly accurate description of Wynn Resorts right now. We're looking at a company that operates almost entirely at the absolute apex of the market, and their recent filings, they really just reflect that strategy perfectly.
Yeah, so welcome to the deep dive. Today we're taking on a special mission specifically tailored for you, the retail investor listening. We're putting our Talk Tickers hats on to break down the Wynn Resorts Q1 2026 earnings fall. So we are getting past the corporate speak and the PR spin to figure out what these numbers actually mean for your portfolio.
Because that's the whole point, right?
Exactly. We are going to be data forward, we're going to be opinionated, and highly focused on the actual mechanisms driving this business.
Yeah, because knowledge is only valuable when you can actually apply it. So we are looking at the raw numbers, the consumer behavior that's driving that cash flow, the massive capital allocation bets that management is making on the future. And ultimately, we'll give you a clear verdict on whether the stock is flashing a bullish or bearish signal.
Right. So I want to dive straight into the headline numbers because the sheer scale of the cash flowing through these properties is it's staggering. Let's look at Las Vegas first.
Okay, let's do it.
So in Q1, Wynn Las Vegas generated $661.9 million in operating revenue, which resulted in $232.5 million in adjusted property EBITDA. There's a 35.1% margin.
Which is huge.
Massive.
Yeah.
And, when we talk about EBITDA, that raw cash profit from core operations, before you factor in debt and taxes, seeing a property keep 35 cents of every single dollar that walks through the door in a highly competitive market, it's just remarkable.
It really is. That margin is, it's the cornerstone of their entire valuation. And when you compare it globally across their other properties, the contrast is what really tells the story of their whole business model.
Well, let's actually look at that contrast because the math between their different regions, it feels almost counterintuitive at first glance.
Yeah.
Like if we move over to Macau, their Asian gaming hub, the property brought in nearly $1 billion.
Right. Huge volume.
Yeah, specifically $989.2 million in revenue, generating $279.4 million in EBITDA. But if you do the math, that results in a 28.2% margin.
A decent drop from Vegas.
Right. And then in Boston, Encore Boston Harbor did $205.7 million in revenue, landing a 24.6% margin on $50.5 million in EBITDA. So you add it all up, and their trailing 12-month global EBITDA is almost $2.3 billion.
A staggeringly healthy baseline, honestly. But that margin discrepancy you pointed out, between Vegas and Macau, that is the key to understanding modern gaming stocks.
I really want to push on that for a second, because Macau brings in way more raw revenue than Vegas, like almost $1 billion in a single quarter. But Vegas has a profit margin that is a full 7 percentage points higher. So why is $1 spent by a guest in Nevada so much more profitable for Wynn than $1 spent by a guest in China?
So it really comes down to the fundamental composition of the revenue and, the tax structure surrounding it. Over the last decade or so, Las Vegas has successfully transitioned into a full-spectrum luxury destination.
Meaning it's not just about the casino floor anymore.
Exactly. Yes, there is obviously a massive casino operation, but that Vegas revenue is heavily padded by non-gaming amenities. We are talking about standard rooms going for $500 a night, high-end retail leasing, and massive, massive food and beverage operations.
Oh, I see. So the margins on like a $200 steak or a designer handbag are offsetting the heavy operational costs of the actual casino floor.
Spot on. And furthermore, gaming revenue itself carries vastly different costs, taxes, and promotional expenses depending on the jurisdiction you're in. Macau, while it definitely has beautiful non-gaming amenities, is still heavily, heavily driven by the gaming floor itself, specifically the premium mass and VIP segments.
And the taxes are higher there, right?
Much higher. The taxation on gaming revenue in Macau is significantly higher than in Nevada. So Macau essentially acts as this incredible volume engine, driving massive top-line cash, while Vegas has evolved into an ecosystem that extracts maximum efficiency from every single guest interacting with the broader lifestyle brand.
That distinction really frames the consumer behavior we're seeing right now. Because Vegas isn't just surviving, it is booming. They reported the best March in the property's history.
Yeah, the numbers were wild.
Right. Casino revenues in Vegas were up 9%, which is solid, but the hotel metrics are where the pricing power becomes so obvious. RevPAR, which is revenue per available room, that was up nearly 10%, driven almost entirely by a 12% increase in room rates. People are willingly paying a 12% premium year over year just to sleep there.
And, you know, that isn't just an accident of inflation, right? It is engineered compression.
Engineered compression.
Yeah.
What do you mean by that?
Well, management specifically called out the success of new ultra-luxury spots on the property, places like Zero Bond and Sartiano's Italian Steakhouse. They aren't trying to pack the casino with low-limit players looking for a cheap buffet.
Right, the old Vegas model.
Yeah, that's dead to them. They are cultivating venues that attract the see and be seen demographic. When you bring that specific crowd in, they do not balk at a 12% room rate hike. It's just the cost of entry for them.
Plus, I imagine when those massive citywide conventions hit Las Vegas, the executives and the VIPs, they want to stay where the premium dining and the nightlife actually are.
Exactly. And that compression allows Wynn's revenue managers to just keep pushing those nightly rates higher and higher without experiencing any real demand destruction.
It is basically a textbook example of inelastic demand in the luxury sector.
Yeah.
Like, price goes up, demand stays the exact same.
Which is the dream for any business.
Right. Now, let's contrast that Vegas luxury lifestyle with Macau's core gaming consumer. The numbers in Macau show the mass market drop was up 19%, and the handle was up an incredible 32%.
That is a huge amount of money cycling through the tables.
It's massive. But there's a catch in the report.
Yeah, management had to issue a caveat. They noted that a lower than expected VIP hold negatively impacted Macau's EBITDA by $17 million this quarter. So we've got drop, handle, hold. Can you translate this casino jargon for our listeners?
Yeah, this is a classic trap for retail investors reading a gaming transcript, so it's important to understand. You have to separate the volume of the business from the statistical variance of the games.
So when you see handle up 32%, that is the true pulse of the business. The handle is the total amount wagered. It's the sheer velocity of chips moving across the felt, people betting and rebetting. A 32% increase means the demand is absolutely roaring back in the premium mass sector.
So handle is the volume, but the hold, that's the percentage of that handle the casino actually kept as profit, right?
Exactly.
So hold is basically the house edge catching a bad break. Like, the volume of people betting was massive, but the casino just got slightly unlucky against the VIPs this quarter to the tune of $17 million.
That is exactly it. That is just the nature of the VIP segment. I mean, baccarat players betting hundreds of thousands of dollars a hand can create massive swings in a single quarter. But as an investor, you should never penalize a gaming stock for short-term variance and hold if the handle is growing that aggressively.
Because the house always wins eventually.
Right. The math always corrects itself in favor of the house over time. The 32% jump in handle is the fundamental takeaway there. The $17 million miss is just noise.
Okay, that makes a lot of sense. Now, while the revenue side is robust, we do have to look at the cost side of the equation. Because operating expenses, or OPEX, they are creeping up across the board.
Yeah, inflation spares no one.
Seriously. They were up 6.8% in Vegas and 9.9% in Macau. And Boston, which actually managed to grow revenue by 2% despite brutal northeast weather and some new competition over the border in New Hampshire, they're also seeing costs rise. Management highlighted wage increases, normal cost of living adjustments, and specifically union-related payroll increases in Boston.
Staffing these massive luxury resorts is incredibly labor-intensive. When you have a high-touch service model, inflation hits your payroll hard. You can't just automate a high-end concierge. So the critical question for you, the investor, is how management responds to that margin pressure.
And what really stood out to me in the transcript is their flat refusal to compromise the product. They noted they are mitigating these payroll increases by finding back-of-house efficiencies, but they explicitly stated they refuse to shrink food portion sizes or, cut the thread count on the sheets just to save a few cents on the supply chain.
It's akin to a premium car manufacturer. Like, if Porsche is facing supply chain costs, they don't suddenly start swapping out premium leather for cheap vinyl to protect a quarterly margin.
Because that ruins the brand.
Doing so destroys the pricing power of the brand over the long term. Exactly. Wynn's management understands that their customers are paying a premium specifically for an uncompromised experience. If you start cutting corners, well, that 12% room rate hike becomes impossible to justify next year.
That's a really great point. And speaking of the long term, that leads us directly into management's guidance and capital allocation. Because with nearly $2.3 billion in global EBITDA generated over the last year, they have a massive war chest.
Oh, yeah. And they're placing some massive bets on the future with it.
The most ambitious one being Wynn Al Marjan in the United Arab Emirates.
Yeah, the scale of that project is really hard to overstate. They currently have over 22,000 workers on site.
22,000. It's essentially a small city building a mega resort.
Pretty much.
And Wynn has contributed $1.01 billion in equity so far, and they estimate having about $350 to $450 million remaining to contribute. However, they did temper expectations just a bit by announcing a, quote, modest delay to the timeline.
Yeah, well, the logistical reality of building in that region right now is complex, to say the least. Geopolitical conflicts have caused significant disruptions in the shipping lanes. Freight rates have spiked, and materials often have to be rerouted entirely, which, naturally extends the construction schedule.
Right. And looking at the transcript, management addressed those geopolitical concerns head on. They stated very clearly that they underwrote this multi-billion-dollar project, fully aware that the region inherently carries geopolitical risks, but they pointed to the UAE's track record of navigating regional conflicts over the last 20 years. They noted the defense infrastructure has performed exceptionally well, and day-to-day life and commerce in the area have remained stable.
Yeah, they are taking a very pragmatic approach there. A modest delay due to supply chain rerouting is a localized logistical issue for them, not a fundamental failure of the investment thesis. They believe the UAE's world-class airport capacity and its aggressive commitment to becoming a global tourism hub make this a durable generational asset. So they are keeping the construction teams moving and remain committed to opening in 2027.
Which is a fascinating long-term play. But if we pivot back to Macau, they announced another massive capital allocation that I honestly find even more intriguing from a strategic perspective.
The Enclave.
Yes, the Enclave at Wynn Palace. This is a $900 to $950 million investment for a 432 all-suite hotel tower. But the kicker here, and this is what blew my mind, is that this billion-dollar tower includes absolutely zero new gaming space.
Not a single square foot dedicated to a new casino floor.
Okay, if I am an investor looking at a gaming company, spending almost $1 billion on a tower with no gaming attached seems totally out of character. Like, is this an admission that the gaming market in Macau is saturated and they have to pivot to being a pure luxury hotel operator?
It definitely looks that way on the surface, but the underlying mechanism is actually the exact opposite. It is a massive amplification of their existing gaming floor.
How so?
The CEO noted a critical constraint in the transcript. Wynn Palace currently runs at 99% occupancy.
Wow. So they are essentially sold out every single night.
Exactly. They are actively turning away highly profitable premium mass and VIP players because they simply do not have a bed to put them in. And when you operate at the highest end of the market, your biggest players expect to be comped a luxury suite. If you don't have the suite, you don't get the player.
Oh, wow. That completely flips the perspective.
Yeah.
So a new non-gaming tower isn't a pivot away from the casino at all. It's just a funnel for it.
Right. Management estimates that a single room night in that tier brings in about $2,500 in theoretical gaming win. So by adding 432 new suites, they are increasing their room inventory by 25%. They take those new guests and funnel them directly into the existing gaming floors, the restaurants, and the retail spaces that are already built and staffed.
So they don't have to hire a bunch of new dealers or build a new floor.
Precisely. Because this new tower doesn't require the massive overhead of building and staffing a secondary casino floor, the profit flows almost entirely to the bottom line.
The efficiency of that capital is just incredible. They are projecting this $900 million investment will generate $150 to $175 million in annual EBITDA. That is a phenomenal return on investment, basically just bolting a new profit engine onto a machine that is already running at maximum capacity.
And we are seeing that exact same philosophy applied to maintaining their existing assets. Back in Las Vegas, they are initiating the Encore Tower room remodels. This is a 12-month project where they are literally taking 6 floors of inventory completely out of service at a time to refresh the product.
Taking 6 floors offline in a market where they are currently enjoying record-breaking room rates. I mean, that is a massive opportunity cost in the short term.
It is, but again, it speaks to that pricing power we discussed earlier. You cannot charge a guest a 12% premium year over year if the carpets are fraying and, the technology in the room feels dated. They are taking the short-term inventory hit to ensure long-term dominance.
Which brings us to the most important question for our listeners. We have dissected the past performance, the consumer behavior, and the billion-dollar bets on the future. What does all this mean for the retail investor right now? Let's look at the balance sheet and deliver a verdict.
Let's do it. So the liquidity position is incredibly strong. They're sitting on $4.4 billion in global cash and available liquidity, operating at a 4.4 times net leverage ratio.
That's a very healthy buffer.
Very healthy. That tells me they have more than enough dry powder to handle their debt obligations while simultaneously funding the UAE resort and the new Macau Tower.
And more importantly, they are aggressively returning that capital to shareholders. In Q1 alone, they executed $53.8 million in share buybacks, with another $30.6 million already completed early in Q2. Furthermore, the Macau board is increasing its final 2025 dividend to $150 million, and the U.S. board approved a 25-cent per share cash dividend.
They are definitely rewarding the shareholders.
So with all that data on the table, I want to pin you down for an actionable verdict. If I am staring at my brokerage account right now, looking at these margins, the heavy capital expenditures, and the dividend yields, is this a buy, a hold, or a sell?
To answer that, we really have to look at the macroeconomic environment, specifically what economists are calling the C-shaped consumer recovery.
Okay, break that down for us.
So we're in a unique period where inflation, high interest rates, and housing costs are severely squeezing the lower and middle-income consumer. They are pulling back aggressively on discretionary spending, but the top tier of the economy, the ultra-wealthy, is experiencing the exact opposite.
Because that demographic actually benefits from a high-yield environment and asset inflation. Like, their stock portfolios and interest-bearing accounts are generating massive returns, giving them more disposable income than ever.
Exactly. And this transcript is the ultimate empirical proof of that C-shaped recovery. The luxury consumer is firing on all cylinders and showing zero price resistance. When a company can raise room rates 12% during a period of sticky inflation and still record the best month in its history, they possess an economic moat that is incredibly rare.
So the core business is highly insulated from everyday economic shocks.
Yes. Therefore, the verdict is a strong bullish signal, particularly for income-seeking investors. You have a business generating massive free cash flow, protected by a bulletproof clientele, and management is actively buying back stock and raising dividends.
But there has to be a risk factor here. Nothing is a sure thing.
Right. The actionable warning is your personal tolerance for international volatility. We unpack the UAE supply chain challenges. While management is handling the logistics well, global geopolitics remain unpredictable.
Yeah, that's outside their control.
Totally. If you are the type of investor who loses sleep over international headlines, delaying construction schedules, or impacting shipping lanes, the heavy exposure in the Middle East and Macau might not fit your risk profile. But if you trust the resilience of the global luxury consumer, the fundamentals of this specific operator are rock solid.
All right, let's summarize the key Talk Tickers takeaways from this deep dive. First, Las Vegas is an absolute margin monster, proving that creating a full-spectrum luxury ecosystem is significantly more profitable than just running a casino. Second, Macau has massive volume returning to the premium mass market, and you shouldn't let short-term bad luck at the VIP tables obscure 32% jump in the actual handle.
Yep. And third, management is deploying their massive cash reserves aggressively. They're making billion-dollar bets in the UAE and Macau to ensure they capture every single premium customer willing to travel, all while shrinking the float with consistent stock buybacks.
But I want to leave you, the listener, with a final thought to mull over, one that stretches beyond just this quarter's earnings. We've seen how bulletproof the luxury consumer seems right now, completely ignoring inflation. But as Wynn builds massive $900 million non-gaming towers just to funnel bodies into their existing spaces, it begs a really fascinating question about the future of the industry. In the modern era, at what point does the casino just become a side amenity to the luxury hotel rather than the other way around?
The paradigm is definitely shifting. We are watching the evolution of a business model in real time here.
And how should Wall Street value a stock that is slowly but deliberately transforming from a traditional gaming operator into an apex lifestyle brand? Because right now, they're the kid getting straight A's in luxury, and the rest of the hospitality class is just trying to copy their notes. Thank you for joining us on this deep dive. Keep questioning the numbers, look for the mechanics driving the data, and we will see you next time.